Today, folks, so many of you have been showing me so much love down in that comment section below by leaving questions that I absolutely love reading because it leads to a really good learning experience for everybody, whether it's synthetic dividend reinvestment plans, globalizing a dividend stock portfolio, or how I go about investing in my corporation. This will be the video for you guys, so consider hitting that like button if it's something you'd appreciate. And if you want to support the channel, chat with me 24/7, 7 days a week, along with other 6 and 7 figure investors. You can always just support me on Patreon, get in my WhatsApp group. I post private videos here as well. I'll be doing some very shortly, but let's get into this with Q&A numero uno coming from James, saying again, why so much US focus with you? You're such a US investor, damn it. VYM and that Schwab ETF both track US only. Why not buy a VHYL? Not sure of a Canadian listed version, but it's Vanguard all world high yield, better diversification and value, and outperforming VYM. This is a really intriguing question because I've never looked at this ETF before, so let's analyze it a little bit. It's the FTSE All World High Dividend Yield ETF with 1,814 stocks with an expense ratio of about 0.3%. The distribution is about 3.56. You wipe out that 0.3% expense, you're looking at around 3.26 on the dividend. But let's take a look at the portfolio itself. So this one's very intriguing to me because, man, you get a lot of diversification. United States, 43%, Japan, 8% almost, United Kingdom, Switzerland, Australia, Canada. This one's pretty diversified to say the least. And just taking a look at some of the top holdings here, I mean, ExxonMobil making up 1.84%. You got J&J, JP Morgan, Chevron, Procter & Gamble, Home Depot, Nestle, Merck & Company, AbbVie. I mean, this is insanely diversified. I mean, this is something that I would look at as if I was going into retirement, and I'll explain why, because the dividend growth here is very healthy as well. You're getting about 0.36 cents to about 42 cents a decade ago. Today you're getting about 77 cents to 97 cents. So you're just getting slightly over a doubling of that dividend, which is really nice to see. But taking a look at the performance itself, we've got about a decade's history here since inception, and you're getting about a 54% return. Tap on, that 3% dividend over a decade, an extra 30% plus the dividend growth, you're probably getting around a 90 to 100% return. So doubling your money at least over the decade, which is my bare minimum to buy any stock. If it doesn't double over 10 years, I'm not really intrigued to buy it. But why wouldn't I buy this? Well, let's do the comparison to some of the US stocks, because I'm only 30 years old. In my 20s, I was super aggressive into individual US stocks because that's where the money was being made. And if you compare any ETF across the world, it's very hard finding the same performance that you get out of VOO. I mean, VOO over the last decade is up 176, 180%, not including the dividend. SCHD, this thing going back to 2013 here, because now we're in 2023, man, time's flying, is up 150%. You tap on the 3%, 3.5 yield. I mean, you're getting like 180 to 200% return off this one as well, right? And take a look at this, because the expense ratio on the Schwab US Dividend Equity ETF is only 0.06%, and VOO is only like 0.02%. So you're not paying anything in an expense, so you're keeping most of the dividend to yourself. And when we're talking about dividend growth, look at the Schwab US Dividend Equity ETF 10 years ago, paying 20 cents to 23 cents to today, where you're getting 64 to 70 cents. So over tripling of the dividend. The past history doesn't represent future returns, but if that's what we're basing, like where we're placing our bets on, these stocks are just crushing it. And I do about a 50-50 split. So I put 50% of my money in the US, 50% of my money in Canada, maybe not 100% that way, because I do own some foreign stocks like Taiwan Semiconductors. But I mean, look at like VCE. This is the Canadian Vanguard ETF. So similar to VOO, but on the Canadian side of the border. And if we go back to 2013 here, I mean, the performance doesn't even come close, right? I honestly think maybe in time, this is going to change. I think the Canadian economy is going to begin to grow pretty well here. I hope. I think it will. Population. There's a lot going on in Canada. But I mean, you're up 68%. You're getting about a 3-4% yield with this one. So you're getting a doubling of the money as well. But again, nothing compared to the US. So for as long as I'm a little younger, not like my parents, I'm going to be a little more concentrated. But I think I'm pretty diversified, to be honest. I don't know if I need to get much more diversified than I am. But let's get into the next question. From Shakepay. Chicklet, am I saying that correctly? Would love to know how you invest in your corporation. I have a holding company and would love to know your strategy. A video would be great. So this is very convoluted. You really want to talk to a tax professional about this because first and foremost, I do this for a few reasons. It stops me from having to pay a lot of tax on the income I make in my corporation because in Canada, corporate tax is like nothing. It's like, I mean, you're paying like less than 15% on the first $500,000. It's incredible. So I leave my money in my corporation and I invest it under that corporate umbrella. Here, however, there's issues that come with this. So dividends and capital gains get taxed at 50% in a corporation. So if I sell a stock, make capital gains, or collect a dividend, the government immediately wants to take 50% of that because it's passive income, and they already give you a good tax break on the money you're making. So how do you avoid that? Well, you have to pay it out to an employee. If you pay out a dividend to an employee, it completely waives any dividend tax you would pay on it. So that way it passes the tax on to my personal income. It's a bit convoluted that way. However, it's a good thing to do, especially if you have RSP contribution room. You can pay yourself out of your corporation with the dividends. Just deposit it in your RSP and you'll pay zero tax from start to finish. That's kind of the loophole that I figured out. But honestly, for a corporation, I just buy regular stocks. There's nothing that changes my strategy on the same stocks in my corporate account that I do in my tax-free savings account. It's just a matter of it divvies up some liability. In a corporation, it kind of removes yourself from the liability. It's a separate entity. So if I kill someone in a car accident or something, they can't go after the corporate money. And same if you get married, divorced, it's harder for your wife to take the corporate money, or if you love your family, you pass on. It's way, way easier to gift the shares of your ownership in the corporation to your wife to take over it, whether like rather than a TFSA or RSP where you have to go through the government hoops and hurdles. Typically you have to sell the stocks, pull them out of the tax advantaged account, put them into your own. It's a bit of a mess. Corporations are very intriguing, a lot of tax loopholes and weird things going on in there, personal write-offs. I mean, I should do a video in and of itself on that topic, but I mean, like I said, it is what it is. Talk to a tax accountant. I hope I gave you a little insight there. Let's talk to Kane saying, what options do I have to purchase dividend stocks in Canada? Do I need a licensed person to assist? You can, if you have a professional investment advisor, by all means. I think this is a pretty simplified question. Most of you know the answer to it. If you watch PPCE or dividend investors, they tend to buy Canadian stocks as well because they're so advantageous from a dividend standpoint. Like let's use Royal Bank as an example here. Some of these banks are paying 6% and they trade on both exchanges. So here's Royal Bank trading on the New York Stock Exchange. You could just look up this ticker on the NYSE and you could just buy it in the US as a US stock, right? And it kind of has both counterparties. You have the Canadian listed version and the US listed version. Very easy to do, but nonetheless, let's take a look at what Will Keane says. Holding RY and BNS and are never going to sell stocks for me. They never sell stocks for me. I love the Canadian banks. I think they're lifers as well. I've noticed you use RBC direct investing. If you use the synthetic drip as I do I get the 2% stock drip discount? I'm thinking no, and you need to own the stock directly. Your thoughts would be greatly appreciated. So there was a video I talked about with Bank of Nova Scotia. There's a few other banks and there's companies like Northland Power where if you set up a drip enrollment, so a dividend reinvestment plan, the company will actually give you discounts on the shares that get repurchased. BNS right now will give you a 2% discount on setting up a drip enrollment plan. So you get an immediate 2% return on your shares when the dividend gets reinvested. But however, people are saying that if you're using something like Questrade or basically any third-party broker, that the broker is the one buying the shares, so you don't actually get the 2% discount because you're not getting them directly from the company. And I honestly have no idea. So I've tested this out with Scotia iTrade, and I know for a fact that you do get the discount on the drip. I've done it with some of the bank stocks, Northland Power. I've tested it out. I've seen it work. However, with RBC, I've never done it. I don't do I don't do dividend reinvestment plans in my Royal Bank account. I've never done it with Wealthsimple or any of these other third-party accounts. So you're just gonna have to test it and see if it works. Just wait for you to get your share payout, look at what they actually paid you, and see what the stock price is on that day. If it's 2% cheaper, then you know you're getting a deal. But you're gonna have to let me know in the comment section below because I'm not privy to that. So how do you avoid buying VFV and put your money into VOO? Very simple question. I get this all the time. It's like a broken clock on this channel. So I open up Canadian and US brokerage accounts in the umbrellas of my TFSA, RSP, my managed accounts, my corporate accounts. I like severing my currencies. Now, yes, I have to pay an initial conversion fee for that, but I only have to pay it once, and then all the dividends and everything I make stay in US dollars. So in my TFSA here, you can see I have VDY, and this is in Canadian dollars, in the Canadian side of this brokerage account. On the US side of it, I've got SCHD, TSM, and VOO. These are all in US dollars. So when I get paid a dividend from these, it stays in USD, which we can see here. There's no conversion fees or anything. I just purely get US dollars. I can reinvest those US dollars. I can pay myself out in US dollars into a US savings account, and I can pull those USDs out in cash. I could spend them in Canada. I could spend them in the US. I could go to China. Most people accept USDs globally. And of course, I get my Canadian dividends here as well. So it gives me an option to buy US stocks and Canadian stocks without having to constantly deal with conversions or BS or buying some like a depository receipt thing, like, you know, the way you can buy like other versions or like VFV, right? Like you could just buy VFV if you're not privy to dealing with multiple currencies. But personally, I love it. It's just something that I've come accustomed to early on in life, and I think I like working in a multitude of currencies. But I'll pass the question off to you at this point. I'd love to know what you guys think. Let me know your comments, questions down below, and we'll obviously continue doing these Q&A sessions because personally, I love them.